Welcome. Ramadan is saying good afternoon to everybody. Yes, Ramadan, good afternoon to you. Felix Brixen, thank you for sending that timetable for the members to review. And members, thank you so much. This juncture, allow me to share our screen so that we can be able to get to our lesson. Central, Western, one common take it. Every night, that is what they do with the countries. The Sahel, region. But here, so members, we are getting to our slides. Just a quick review. My name is Teacher Paul Auha, one of the teachers in this country. Particularly, I am established in the eastern region of this country, within Mbale City. So I want to thank you, especially the participants who joined our lesson last week. It was really tremendous that we were together. Members, at this point in time, a quick review was we handled the understanding of national income. We had the objectives then to achieve, like we shall be mentioning what we are meant to achieve in this lesson. We did look at the definition of national income, and we related it to personal income for better understanding. We did look at the importance of national income. We looked at a few elements there, which we discussed. From then, we proceeded to the overview, key concepts. We tried to look through those key concepts as you can see them on the slide. We did take on one by one, defining what each of them meant with a few examples. So by the end of our lesson, we were looking at transfer payments. We did look at the transfer payments, and that is what we are dealing with at that time. So by the end of our lesson, I had tasked members, colleagues who were attending the lesson to go on and do a bit of research into what we are going to be doing. As we are already aware now, we shall be continuing with that lesson. Yeah, sorry, a little. We are trying to work on our slides. See? We wanted them to be displayed in a manner that is a manner that is required. So, yes, we are going to have our slides on. I am seeing some 23 participants. You're all welcome, members. And sorry, members. We are trying to work on, was a bit of technical hiccup in our slides. We need to be patient a little as we align them. We wanted them to display in a manner that is required. The manner that is required.
You would want a car. It says you can buy it. That the revenue is somebody gets, but you use the cars for reimbursement. You get a car. Now for us, when you put it after
Yes, so members, we are on, and we are going to begin our presentation here from slide 13. And basically, what I wanted here for us is to ensure that we look at the adjustments in national income. In our previous presentation, we looked at national income, the concepts that are very critical and key to it. And then we did look at the last part of it, which was the transfer payments, which we said in most cases do not constitute when we are computing national income. Today, we want to ensure that we address the adjustments, because national income adjustments are critical. When we speak of national income, we do not speak about national income as one complete thing. We speak about national income into different portions because that helps us to understand what national income exactly is. Besides just speaking about it or talking about it in one complete format. So we need these small segments so that we can be able to clearly understand the concept of national income. Now, from the slide that is on our screen, basically it is adjustment in national income. We said, one, we can adjust national income from gross to net. And what is the attendant is in front of that arrow. We simply subtract the value of depreciation. B, we can adjust national income from net to gross. And That one is also addressed by the information at the front of the arrow. So we add the value of depreciation. Number two, from the domestic, you can adjust national income from domestic to national. And what is attendant is what is we have also reflected in front of the arrow. Now, besides in 2B, we say we can also adjust national income from national to domestic. And this is done with the information or following the procedure behind the arrow reflected. In number 3, we say from factor cost to market price, we do address it following the information that is in front of the arrow. In item 3B, we can also adjust national income from market price to factor cost. And this one is also addressed using the information that is in front. Maybe for purposes of interaction, members, I think we are going to open up the microphone for the participants. Let me get the participants so that we can be able to interact a bit before we go deep into that area. Mr. Okay, let me speak to Frank. Frank, can you please unmute and we interact a bit, especially if you are to comment on the display quality on the screen. Frank, unmute for purpose of interaction. I'm asking Frank to unmute. Okay. Frank seems to be having a challenge. Gabriel?
Sir,
Yes, please.
good afternoon, sir.
Good afternoon,
So,
Gabriel.
no, this is Franklin.
Okay.
Yes, so my issue is,
Mm.
I did attend the previous lesson. Maybe if I would have like maybe screenshots I can read through and get to know, like from national income to where we are.
Okay.
Thank you.
That is good. Thank you, Frank. Felix? Felix? Let me ask Felix to unmute for a brief interaction. Felix? Yes, Felix, unmute. Yes. Felix. Felix. Yes, okay. We can have the non-verbal feedback. We can have the non-verbal feedback. And have the non-verbal feedback. Let's have the non-verbal feedback going on. Hello? Yes. Well, clear. Okay. just a little. We are having some bit of feedback in the background. Let's simply relocate a bit and have some space a bit. Yeah, members, there was a bit of interruption in the background. Sorry for the interruption. However, we were saying that we needed a bit of feedback from each of you, such that we may be able to continue the interaction of the lesson. Members, you'll forgive us. We were supposed to have this slideshow of this, but there is a bit of challenge that has come up. So what we do is we will continue addressing this concern as we go on. So we are interested at this moment looking at the adjustment of national income. Indeed, as I said, it is necessary to adjust national income for us to understand it better. We will get to the next slide and just continue, because this is the assignment, the task that I gave the members to make sure that they go on with. So we're supposed to look at those adjustments. Unfortunately, many of us are joining in for the first time, but those members who were in attendance in the last lesson, these were the areas that we're supposed to research on. The adjustments in national income, and then there are some examples to consider when we are calculating for the adjustments in national income. One of these areas is the GDP. Given GDP, we are required to obtain NDP, that is national net domestic product. And then we are also supposed to consider GNP, so that we may be able to obtain the NNP. So GDP is gross domestic product. NDP is net domestic product. And then GNP is gross national product. And the NNP is net national product. On number 3 here on our slide, we have what we call GDP, MP, that is GDP at market price. MP stands for the market price. And when we come to GDP at factor cost, FC, that is GDP at factor cost. The FC stands for factor cost. So we are required to make those adjustments, either from MP to FC or from FC to MP. In number 5, that is number 4, 3, and 4 handled at the same time. In number 4, we have GDP that is supposed to be converted to at factor cost, which is meant to be converted to GDP at factor at market price, from factor cost to market price. In number 5, we will be required to convert GDP and obtain GNP, gross domestic product, in order to obtain gross national product. In the same manner, in item 6, we will be required to convert our GNP and obtain GDP. And in number 7, we will be required to convert GNP at factor cost and in order to obtain GDP at market price. So members, when you critically look at this, we are meant to work through. This is quite a lot of work for us to go through slowly by slowly. So at this moment in time, we have to just continue and make sure that we address these concerns. So at this point, I think I will be requesting the participants to, those who have a bit of idea from what I requested last time, if you did make some bit of research, you can quickly give us your input before we get to the next slides to see what we can really do, especially when it comes to computation. So I am going to identify people whom I think were there. 30, I'm requesting 30 because 30 in our last interaction, 30 seemed to be available. Can you please unmute and say anything about your findings on any of the aspects or items that we have tried to display in the current screen? 30? 30? Yes, there is one hand raised. So one hand raised. Let's get to this person who is raising the hand.
Excuse me, teacher.
Yes, Nambi.
Good afternoon, teacher. Teacher,
Good
I'm kind of
afternoon. How are you?
I'm so sorry to take us back, but I'm just requesting for the definition of national income, if you
Okay.
don't mind.
Nambi is requesting that we have the definition of national income. Yes, I think we can quickly run there. I don't object. Martin, can you unmute and say something? Martin?
Good afternoon, teacher.
Good afternoon. How are you? Martina?
I'm okay. Yes. So I didn't attend last week's lesson, but I was able to do some research. And I
Yes.
think how we can calculate the net domestic product, NDP, given the GDP, which is the gross domestic product. We just basically have to get the GDP and subtract the value of depreciation. Yes.
Okay. That is okay. That is good. Input. That is good input. We appreciate you for that input, Martina. As a student, we expect you to do a lot of research. So, members, I think that one has been a good one from her in obtaining. Maybe let me get to the chat here. Teacher, I have nothing to say. That is 30. Okay. Felix, adjustments, meaning that reducing national income or, okay. Someone is again saying, Master, I didn't attend the previous lesson. That is Ramadan. Good, Gabriel. We were able to hear you, but the background noise, yes. I changed the location. Sorry for the interruption that we suffered. There were some people who just thronged into my place. So we managed to clear that. Then someone is saying, teacher, elaborate on 3 from factor cost to market cost, market price. Yes, that is it. That is the most critical one. This is the most critical one because at least the others, we talked about them. Am I the only one who can't seem to hear anything? As of now, I think everybody could be hearing something. Are we supposed to answer? Yes, this is an interactive lesson. We are supposed to answer. That is the information in the chat. Jordan says GDP at factor cost is equal to GDP at market price minus indirect taxes plus subsidies. Okay, that is good. National income refers to the total money value. That is Felix trying to help our friend. Remember, Martina said she did not attend. So national income, Martina, refers, if you are together with us in the chat, refers to the total monetary value of all final goods and services produced in an economy out of the productive activities in a given period of time. And usually, yeah. So thank you so much. Thank you so much, Felix. For that input. It has saved us a bit of time to get to our colleague who did not answer or attend our previous lesson. So thank you, everybody. Now, members, at this point in time, we are going to proceed on and get to the bottom of calculation of GDP. How do we calculate GDP? When we are to calculate GDP, we are going to use some figures, hypothetical figures, and hypothetical settings, such that we can be able to understand. So GDP stands for Gross Domestic Product. And Gross Domestic Product, as we discovered last time, we said the total monetary value of goods and services produced within the geographical boundaries of a country in a given period of time, which is usually a year. Now, this is gross. Gross involves all people, whether nationals or non-nationals. And at the same time, it does not point to the net or does not exclude the value of depreciation or anything. So it is gross, wholesome. So in this slide, we have been given that gross national income is shillings 285 million, and net income from abroad is shillings 25 million. And we are required to calculate the gross domestic product. So prudently, what we have to do is we have to get the GNP. GNP from the statement is 285. Then we have been given net income from abroad, which is 25. And we are required to calculate gross domestic product. Here we need to understand the formula. And what they want us to calculate is GDP out of GNP. So on the screen, we are having a formula that GDP is equal to GNP minus net income from abroad. Okay, so that is how we are going to do what? That is how we are going to get it. Now from the formula above, that we have been given GDP is equal to GNP minus net income from abroad. So I don't know if there is anybody who can quickly give us an answer. If you are having a PC, your exercise book or notebook, you can try to work this out. And I am going to request one person who is ready to put up your hand, and then you can help us solve this simple arithmetical problem. Yes, any hand that is up, if you have got something, I'm going to ask Nyakato to unmute and give us some input. Yes, Nyakato.
Good afternoon, everyone.
Good
So,
afternoon. How are you?
and to get the gross domestic product, we're going to get the gross national product, that's net income from abroad, which is given in the question, which will be shillings 285 million minus 25 million, which will give us which will give us 260 million, which will be the gross domestic product.
Hey, it gives us how much in shillings?
260 shillings, 260 million.
260,000. Okay, thank you so much, Nyakato. Let's try to see if it is going to give us that. Now, when you look at what has been dropped down there, we are getting a GDP of 285, and we are reducing or subtracting to the tune of 25 million, which gives us 260 million shillings as the gross domestic product. Okay. So we have converted GNP into GDP by subtracting net income from abroad. Okay, as we were given in the question here, and it leaves us with 260 billion as a GDP. Okay. Yes, let's proceed on. Thank you so much for that input. Now, having done GDP, we are proceeding to look at the calculation of GNP using some hypothetical figures again. The task ahead of us is, given gross domestic income is shillings 285 shillings, a million shillings. And the net income from abroad is 26 million shillings. Calculate the gross national product. Gross national product. By definition of gross national product, like we handled last time, we said gross national product refers to the total monetary value of all goods and services, productive goods and services produced within the boundaries of the country by only nationals, and including the value of output by nationals living outside the country. So here we add the value of national income produced by nationals. Those are the citizens of a given country, like Ugandans living in Uganda, plus the value of national product by still Ugandans living outside Uganda. So we get what we call gross national we get what we call gross national product. That's how we derive it. Now, I want us to quickly look through this, and then we get our figures again from the task. We have been given GDP as 285, and net income from abroad as 26 million. And they want us to calculate the GNP. Okay. Now, in this respect, GNP, if we are to find the GNP, we are going to look at the gross domestic product, which is the GDP, the value of what is produced within the country, plus net income from abroad. Now, when we talk of net income from abroad, we are referring to income of nationals within and the nationals outside the country. At the same time, we exclude from GDP the value of product or output contributed by the non-nationals, the non-citizens of Uganda. We are taking Uganda as a case study. So if we have Chinese and we have Indians working here and raising income, our GDP, we must make sure that when we are computing GNP, we exclude their product, the value of their product. And then we also go out into other countries like South Africa, like UAE, whatever is produced and remitted by our nationals, we include it into the GDP. And in that way, we shall be able to determine the gross national product. Okay. Yes, now from what we have established that GNP from the task is 285 million. Okay. And the net income from abroad, that is when we say net, it means we have subtracted what the non-nationals or non-citizens produce here. And then we have added with what our nationals living outside here are. So maybe I want us to prove. Can we prove whether what we are seeing is what is expected? Let me have somebody. Arnold, can you unmute and say something?
Yes, sir. Good afternoon.
Yes. Good afternoon, Arnold.
Yes.
Do you think the expression here is the final result is what is expected?
I think so, yes.
Why do you think so?
Because to get the gross national product, you have to get the gross domestic product plus a net income from abroad.
Okay.
And we just had to add, and the answer coordinates with that I placed in the calculator.
Oh, good. Thank you so much.
You're welcome.
Okay, there's something which can be obvious, but now when you bring it out that way, Kembabazi, can you unmute and let's have your contribution?
I have an inquiry. So in
Yes,
the
please.
question, it's given that gross domestic income. So when we see gross domestic income, do we interpret it as gross domestic product?
Yes, that is it. Because soon we will be coming to the three approaches of measuring what? National income. We have three approaches: the income approach, the output approach, okay? So, and the expenditure approach. So either, so when we can say domestic income or domestic product, it all brings us to the same aspect.
Thank you.
You're welcome. Okay, so if we are satisfied there, we can proceed on members and look at a different aspect. Can proceed. Let's proceed. Calculation of net national product. Calculation of net national product. Maybe before we get to the calculation of net national product, can someone remind us what net national product refers to? Or what is involved in net national product? Okay. Jordan? Okay, there is a hand. Let's get to this hand here. That is Tracy. Tracy, unmute. Unmute and speak to us. Yes. Tracy, go ahead.
Net national product is the total monetary value of all final goods and services produced by citizens of a country, both at home and abroad, during a given period of time, excluding the value of depreciation.
Thank you so much, Tracy, for that contribution. Now, members, the subject we are dealing with here, this item is net national product. This is the monetary product of the nationals in the country and the nationals abroad, excluding the value of depreciation. I remember us talking about depreciation. We said that depreciation refers to, I forget. Can someone help us to define depreciation? If you have ever come across, put up your hand. Help pick us with the concept or definition of depreciation. Depreciation. Yes, there's someone with their hand. 2 people. Jordan, unmute. Yes, go ahead.
Depreciation is a reduction in the value of fixed capital assets due to wear and tear.
Okay, very good. Thank you so much. A reduction in value of fixed capital assets due to wear and tear. Thank you so much. So, in the definition of net national income or product, we have that element of depreciation of the value of capital assets due to wear and tear. So I want us to do what? To continue and make sure we again get some hypothetical example and try to calculate, compute net national product. So our hypothetical example here is, given that a country's GDP is shillings 400 million, net income from abroad is 40 billion, depreciation is shillings 20 billion, calculate the net national product. Calculate the net national product. So, as per definition here, you have seen even in the TASIC, there is the element of depreciation. So, every time we are dealing with nets, there is a likelihood of having to deal with depreciation. So, we get down and we establish our figures. GDP has been given as 400 billion. Net income from abroad has been given as 40 billion. Depreciation of capital has been given as 20 billion. And we are required to calculate or to determine the net national product. Our formula would be net national product is equal to GDP plus net income from abroad minus depreciation. That is our formula, which we are meant to use. So with that, I think I request you members to work in the background. Try to work in the background so that we see what we can establish using the figures that we have been given and the formula that has been displayed here. So once you are through, you can simply put up your hand. Meanwhile, let us try to run through the chart. Someone is giving us 42 billion, okay, in the chart. That is good. Mina is giving us 42 billion. Tracy, 42 billion. Stanley is also giving us 42 billion. So we simply need to cross-check ourselves. And then if we prove ourselves right, then we shall get on. So, yes, I am seeing overall people are giving us 42 billion. 42 billion. Okay. So let's see what the presenter has here. GDP, we are given 400 billion. The net income from abroad, we are given 4 billion. So we added that one. okay, to get our GNP. Then we are to subtract depreciation in order for us to get the net. And yeah, the presenter seems to agree with you. So 444 billion, 400 billion plus 40 billion gives us 440 billion minus 20 billion, which gives us the net national product of 420 billion. I think that is wonderful for all of us. I want to thank you for working in the background successfully. There are two more in the chat. Yeah, someone is saying 420 billion. Naume is saying Ziomi is saying 42 billion. Okay. Okay. But okay, maybe she forgot a zero. Because from the expression here, it should be 420. Because we are operating in 100 billions, hundreds of billions, not tens of billions, okay? So thank you so much, Zion, for the input. What you will need to do is simply to add a zero behind the 42 to make it 420. So I want to appreciate all of you. Alien, Amos, Francis, Stanley, I want to appreciate you for the contributions. Mina, thank you for the contributions. Tracy and the rest of you. So let's put this aside and we ensure we move on. We move on and calculate something else. And this is what we call, factor cost, okay? Calculation of GDP at factor cost. Now, in the previous lesson, we did not give factor cost enough attention. Neither did we give market price also the attention. In this lesson, interaction, we have to make sure that we give these two very serious attention. We have to give them serious attention. Now, when calculating national income, there are instances where we calculate it basing on the factor cost and also basing on the market price. You can calculate national income from source, that is from the production sites. But at times it is not possible. You may discover products have left the productions farms and they are already in on the market. So that is why it is important, because when we are calculating national income, computing it, we are not supposed to leave out anything if we are to get the true picture of the national income statistics or figures. So in this respect, we must address both whether we find the goods, the final products at the production sites or in the farms, or whether we find them in the market. The only thing that is critical here is we need to do adjustment depending on the setting we have established the output. If we have established the output in the production stage in form of factor inputs. We do include the costs of production. We calculate the costs of production for those products. But in case we establish that the products that are under scrutiny are already in the market, we have to include other elements. There are two critical elements when we are dealing with factor cost and market price. With factor cost, what we should not forget is what we call subsidies. During the production process, government, which is the father of all sectors in the economy, can decide to give or offer subsidies to producers. And therefore, when we are computing national income at that level, we make sure that we take care of the subsidy which government has offered the producers. However, once the goods leave that stage of factor costing, they come to the market where they are sold. When we are computing the national income statistics and we establish or get those goods at that level, we subtract the subsidies and instead add there what we call indirect taxes. Government in its operations is prudent. It gives and takes. Government will give you a subsidy and after some point will bring its hand and tax you to balance the two. So that's why in the computation of national income at either levels, we need to take care of those two elements. Yes, so we have a hypothetical example to take us through what I have labored to explain. Possibly before we go further into this, let me get to the participants and, ask you to tell us a bit of something. You have been listening, I've been talking. Maybe before we handle the hypothetical example, can someone, in your own understanding, tell us, differentiate between GDP at factor cost and a GDP at market price from what I described? Remember, I described two important issues that are involved with the factor cost and market price. So if you are very attentive, let me get to anybody. If you are not putting up the hand, I'm going to pick one. Here you're going to tell us something, and then Gimbo, you will also tell us something. Okay? If you are not able to, let's begin with Gabriel. Can you unmute and try to talk about factor cost and market price in relationship with national income? Gabriel, be free, feel free, tell us the little that you may. It will help us to refine ourselves and help ourselves better. Gabriel, are you there? Unmute. Meanwhile, People who cannot talk, yes, you are free to drop something in our chat. Okay, Jordan. Jordan, can you unmute and say something? Jordan? 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 Okay. Yes, there is a hand. Somebody has put up a hand. Yes, Kembabazi, unmute and try to give us your perception of factor cost, the market
So,
price. Yes.
from what I understood, our GDP at market cost, we talked about the
Mm,
government offering subsidies to producers, but then we also
mm,
talked about how nothing comes for free, really, because
mm,
okay, this is now GDP at market cost.
mm,
To create a balance, the
mm,
government indirectly taxes these producers who
mm.
enjoy subsidies, but okay, like basically to create a balance, because yes, I've given them subsidies, but then there needs to be a balance, so they also impose indirect taxes. Yeah, that's what I've
Okay.
understood. Yeah.
Yeah, thank you so much, Kembabazi, for that. Yeah, Kembabazi has picked it. Like I said, the government does not give anything for free. It will give you and get it from you. Okay, that is how governments operate. Because they don't have what belongs to them. All they have belongs to the people, but they play right, left, and center. So when they give us subsidies simply support. Can be financial, it can be facilities, physical facilities that government offers producers, produce. But at the end, government needs tax. Otherwise, if it does not have the tax, then it cannot be able to offer the subsidies, because that is the nature of the economies that we live in. Unless if they are welfare economies, but even welfare economies also do charge taxes in order to give their citizens a decent livelihood. Anybody else who, let's check the chat and say, let's check the chat here. See, we are talking about the factors. Okay, we are talking about factor price, not factors. Then Gabriel is saying he's really new in this lesson. Yes, you did not attend last week's lesson. We understand you, but as a student, you have to take the initiative to get into research. I will request you to make sure that you find some notes and then look at the introductory concepts of national income. Yes. Someone is saying, another person, one of our friends is saying, GDP at factor cost, that is Flex is the total money value of goods and services produced within the country, calculated at the cost of production, such as wages, rent, interest, and profits, and excluding the influence of indirect taxes and the subsidies. Okay. Our friend is again, yes, there's some good concept here. The only thing that I don't The only thing that I don't agree with is when we exclude subsidies. Okay? The subsidies must be within when we are talking about factor cost. They are there. So I think that last part of the statement you needed to address there. Otherwise, the rest was fine. GDP at factor cost, we include subsidies from government. Yeah, that is Amos. Gabriel, it is okay. It will be well. This is just the introduction. I know in the previous lessons that you will have, either with us here or in class, we will be able to have a better perception of those elements. Yes, there is a hand. Someone is putting up a hand. And this is Jordan. Jordan, go ahead and mute and talk to us. Jordan? Jordan? Jordan?
Yes.
Yes, please.
I wanted to say that GDP at market price includes indirect taxes, and the GDP at factor cost, it includes the subsidies.
Okay.
Then GDP at market price excludes the subsidies. Then at factor, it includes it excludes the indirect taxes.
Yeah, at factor cost, there are no taxes. Then at market price, there are taxes. So we eliminate the other and leave the other. So as you go to the market, you exclude the subsidies and include in the indirect taxes. So that is good. Thank you for having that concept. Now, in our hypothetical example here, we have been given that GDP at market price is pounds 500 billion. Indirect taxes amount to 155 billion pound, and the subsidies are 200 billion pounds. And we are tasked to calculate GDP of our hypothetical example here at factor cost. Okay. Maybe before we see what the presenter has, can we get members telling us what we are supposed to do? How do we proceed here? Anybody with an opinion? You can either put up the hand or throw into the chat and then give us a way forward. What are we supposed to do in this respect in order for us to be able to calculate and determine GDP at factor cost? Was what we have here. We are having GDP, which is 500 billion pounds. Direct taxes, 155 billion pounds. And then subsidies, 200 billion pounds. And we are tasked to do what? We are tasked to calculate. Okay. We are tasked to calculate. Okay. So, can we have someone Okay. And we quickly, sorry. Yes. How people are trying to work out in the background. Okay. There we are. We have some 5 messages here. Yes, someone has calculated that GDP at factor cost is equal to GDP at market price plus subsidies minus indirect taxes. That is ICRA. Yes. And then Stanley has already given us a total of 545 billion pounds. Okay. It could be market price plus subsidies. We exclude the indirect taxes. That is Brixen. Okay. Then, okay. That is fine. Amos is also saying something that at factor prices we have because the market price plus subsidies. Okay, so let's get to the slide and then see if something can get in. We are saying GDP market price, which we are required to calculate, is equal to GDP factor price minus subsidies plus indirect taxes. I hope that is okay. Hope that is clear. Then we have said that GDP market price is equal to 500 billion pounds and our subsidies were 200 billion, which we are supposed to deduct from that GDP. And then we add pounds 155 in the form of indirect taxes. So let me request people in the background try to work out them and then throw something in the chat. I expect more answers in the chat. If you have arrived there using that formula that is in the chat. Someone is saying 455. Okay. 455. Okay, another one is saying 455. Another one saying 455. Okay, good. So if we are adding indirect taxes, okay, on the GDP and then subtracting subsidies, I think most likely we are likely to reach that point. So let's see. We are having 500 billion less subsidies, which is 200 billion. Okay. Plus indirect taxes. So this is 500 minus 200 gives us 300 billion. Then plus the indirect taxes, which are 155 billion. I think this agrees with many of you who posted 455 billion pounds. Okay. Now, if a task is given and it is including the figures, let's make sure that we even include the units. It's unfortunate our secretary omitted the pound, no, this figure, this unit of pounds. So for us to get the answer right, we must have 455 billion, okay, pounds, because the task has pounds. And if it is shillings, we present it in the unit of shillings. If it is dollars, we also have to present them in the unit of dollars. So thank you so much, members who have dropped in. Prince, you have done it. That is all. Ikra, 455 math. It's okay. Thank you for all of that. Then Prince, I can see you. That is what you got, Tracy. It's okay. Yeah. And then Franklin. Yeah, thank you all for the contribution. And I want to appreciate and encourage you to. Yeah, it is good practice when we in a lesson of this nature, you need to have your sketch book where you need to try out this. So thank you so much for that attitude, the positive attitude. Members, we will be getting ahead. We will be getting ahead. We'll be getting ahead. All of this is what we have been running through. We have calculated GDP, and I am sure by the end of this lesson, you should be able to calculate GDP. We should be able to calculate GNP. We should be able to calculate NNP, Net National Product. We should be in a position to calculate GDP at factor cost. You should be in a position to calculate GDP at market price, okay? And yes, market price. Yes, this is where we are, okay? This is where we are. We have been calculating GDP at factor cost. We did it. We did it. And we have been able to look at NNP, as you see in this slide. We have been able to look at factor cost, as you have seen there, and market price is there for 55. There seems to have been a slide which we skipped. I think we need to also, we need to iron out that one. We looked at market price. Now, I mean, factor cost, GDP at factor cost. And then we're also supposed to look at GDP at market price. Okay. There seems to be a small repetition. Okay. Yes. All of that is what we have gone through. Factor cost we have gone through. Okay. So factor cost we include, we exclude indirect taxes and market price. Market price we exclude. Yeah, there was a challenge with the heading. Calculation of GDP at factor cost, we must have repeated. Yeah, but let's get to this slide 19. So we said in market price we include indirect taxes. Okay. So let's watch up here. That is where we were. So in this, try to look through and see if it gives us what we want. Having looked at the factor cost, here we are looking at GDP at market price. And we have been given almost the same figures. It is us to do what? To change. So we are required to calculate GDP at market price. So we say that GDP at market price is equal to GDP at factor price, factor cost, minus subsidies, plus indirect taxes. And we have been given billion, 500 billion pounds. The subsidies are 200 billion, which we are supposed to remove. That is 300 plus that, giving us that amount we are seeing down there. So we are going to proceed on in our final slide. Our final slide. Our final slide has the factors that influence national income or size of national income. But before we get to that, I would like to receive interactions from the members. Yeah, gross domestic product, that is Prince, is saying the gross domestic product at market price measures the total value of final goods and services produced within the country's borders during a given time, valued at market prices. Okay. And Prince has given us an example by saying the prices actually paid by buyers. That's what we call market price. And those prices which are actually paid by buyers include what we call indirect taxes. Okay. Okay. They include what we call indirect taxes. Jordan says it includes indirect taxes like VAT, excise duty, and then excludes subsidies. Okay. So, yes, it has to exclude subsidies. My friend here, I hope you have taken note of that. Prince, I hope you have taken note of that. When we are talking about market pricing, we reduce subsidies and then include what? Include indirect taxes. The indirect taxes take the place of the subsidies. Subsidies. So that is good. In case anybody has any query, you can drop it in before we get to our final part of the lesson, which are the factors influencing the size of national income. Franklin says, sir, do you mean GDP at factor cost and GDP at market price in calculation are the same? Some clarity. They are not the same. The difference is at market price, you exclude the subsidies, okay? This is what we call what? Subsidies, okay? Let me show you what we mean by subsidies. You see, in the market price, we exclude, hope you are watching there, we are going to minus subsidies. These subsidies here, we exclude them, okay? When we are taking the market price, okay? And instead add indirect taxes. That is how we derive GDP at market, what? Market price, okay? So that is it. So that is it. That is it. I hope my friend here is okay. Now, when we are talking about GDP at a factor price, we include subsidies and then remove indirect taxes, because the indirect taxes at factor cost are not yet there, okay? Because the goods are not being treated at the level where the final buyer is paying them, paying for them, including the indirect taxes. So I think if my friend here, Franklin, I don't know whether we are together. So then what at factor price, okay? Yeah, I think, okay. Franklin says we are together, okay? Franklin says we are together, okay? So that is it. Any other queries before we get to the final part? We have about 20 minutes. And before I introduce the last slide, which has a lot of work for me and you, if there is anybody with any issue, maybe you can put up your hand so that we get you. Somebody? Anybody? Okay. Chat. Okay. Let me see. Two people are saying, sir, this is my first lesson. So what are subsidies? Okay. Can somebody help? Zayomi, if you are there, then Prince is saying, sir, we use the same method for both factor cost and market price. Yeah, of course, the method is the same. It is only what you have been asked to measure, you use the other. If you have been asked for GDP, at market price, then you have to consider GDP at factor cost. Then you either do the subtraction of subsidies or the addition of indirect taxes where possible. Okay? So that is what you do generally. That's what you do generally. Okay, good. Someone is saying the subsidy is a financial or other support given by government organization to an individual, business, or institution to lower their cost of production. Okay. Yes, I agree with the Felix here. A subsidy is financial or material support given by government, okay, to the production units. Production units or a farm. It can be a farm, it can be an industry. To mitigate or to lower the costs of production such that either the farm will be in a position to produce larger quantities of output. And that one, of course, is what we call economic growth. So when government facilitates you and they produce large quantities of output, then we can say the economy is growing. And that is what government really intends when it gives you what? A subsidy. Sir, I think subsidies are the values used to pay factors of production. Subsidy is the support given to a farm by government to meet the cost of production. Yes. It can be to meet the cost of production. It can be, subsidies are given for different reasons. It can be to induce output, such that much output is produced. It can be also to attract more producers to join the production units. And the baseline is government is interested in economic growth. So yeah, those are very good contribution. Prince is saying he is a financial support given by the government, producers or consumers to reduce the cost of goods and services, making them more affordable to encourage production. Okay. Yeah. Government can also give the consumers a subsidy. It is the same, actually. It is upon government to decide. You can give the consumers subsidy if government is targeting they are going to consume certain particular products. And that one is going to act as a driver. The producers will just be forced to increase output even when they have not been given anything. The subsidy has been given to the consumers, and the consumer find it easy and cheaper to consume the products of the producer. So you find, so it's government to decide, sometimes for political reasons, for political reasons, if they feel the money should go to the support should go to the masses down, then they can use that subsidy to the consumers. But if they believe in the entrepreneurs, the producers having farms, the subsidy can go there. So either way, the government is after economic growth, increasing the volume of goods and services produced in the country. As I have told you that in our next lessons, we will be looking at the methods of determining or computing national income. You can use the expenditure approach. You look at how much the consumers have spent on consumption of given products. So once a subsidy is given, government can follow up the consumers and see, are they really consuming as we expected, given the subsidy. So that is good. We have to keep the interaction going. Even after this lesson, you have to keep doing research. Yes, we are going to our final slide in the remaining few minutes, such that we can be able to have it, have it treated. This last slide, we have what we call factors which influence national income. The factors which influence national income. Now, many times when we give you content, we reach a time of giving you tasks. We have different forms of tasks. Now, in the tasks, we have nature of tasks. Now, like in this area that we are going to look at, and those that we have already looked through, the nature of tasks you have seen there, one is that they are primary or direct. If I ask you to define a subsidy, that is a conceptual nature. I need you to know the concept. And the answer should be brief and precise to the question, if you are a good student. We have looked through the nature called arithmetic nature. You have seen we have tried to calculate, and when we give you tasks of, say, determine, calculate, you need to have the arithmetical knowledge. We don't need anything else. We simply need to see how you are presenting your formulas, you are integrating the values that have been given, and calculating the final answer correctly. Here, we shall still talk more about this, but I wanted us to get introduced and run through this in the remaining few minutes. The factors which influence national income. There is a critical element here. The study of economics requires that you have, you try your best to ensure that, your language, your English, your tensing and communication is okay, such that we don't mix up. So the factors which influence, factors which influence national income. The factors which influence national income, as you have seen them in this last slide of ours, is they are in there. The factors are in there. Let's get back to them. I want you to look through them in a few minutes, and then we are going to make some brief remarks on each of the points. And we wind up the lesson. And these are the factors which influence national income. Now, when we say national income, we are looking at the size of national income. Here, we look at the high and the low. what makes national income figures or our national income to be of a high level, and what is responsible for our national income figures be, because that is how we measure. Here we are going to measure the high and the low. So in this, I think we have to look at this. One of them is level of technology. 2 is size of the market. 3 is state of skills or labor skills. 4 is size of capital stock. 5 is, yes, that is 4, 5, 6, 5, level of development of a country's infrastructure. 6 is level of accountability. 7 is level of savings. 8 is level of monetization of the economy. 9 is population growth rate. 10 is government policy of taxation and subsidization. 11 is rate of capital inflow and outflow. Then 12 is level of managerial skills or entrepreneurial ability. So I want to request you to get in here, pick what you want or what you can talk about. We want to listen to some people. Nyakato has a hand up. We want to listen to your argument, given that I've told you here we are dealing with the high and low. Yes, Nyakato.
Teacher, mine is more of a question than a submission.
Mm,
So, in regard to the points of the level of savings, could you kindly elaborate more? Like, are they looking at the individual
Sorry? The level of savings. Yeah, Nyakato is talking about this element, this point of level of savings. How does it influence or affect the level of national income? Okay. Now, when we have high savings or large volume of savings, those savings can be used for investment. And the investments will be high levels of investment, which will translate into high levels of output, hence a high level of national income. Whereas where there is low levels of savings, this is going to undermine or minimize the level of investments, and that this will affect the output levels, hence low level of national income. So that is what I can say basing on that. Let me see if any other person can be able to say anything in the chat. What of degree of economic stability? Okay, so please help me. I join late the recording in the group and I send the recording. Yeah, these recordings are in most cases sent on YouTube. Yes, Mr. Kaziba is in charge of that. So we will have to upload them to our YouTube channels. They are there. Even the lesson for last week was uploaded on the YouTube channel. Those who missed can be able to get there and find it. Okay. So yes. Let me hear from somebody. Yes. Nyakato again.
I'm sorry, teacher. I didn't get your response to my inquiry. I was kind of requesting if you could
Hey,
repeat.
hey, you talked about, you requested us to talk something about the level of savings. You simply say
Yes.
high level of savings, see? Okay? Supports or promotes investment, okay? And hence high levels of output. So when we have high savings, the high savings are going to support or promote investments, which investments translate into high levels of output. Whereas
Uh,
low levels of
teacher,
savings, yes, please. Yes.
my question was not
Mm.
okay. My question is about how do these savings come about?
The
Are they
savings.
individual savings? Like, yes, please. Are they
Yeah,
country
of
savings
course.
or? And I
Yes,
was
of
asking,
course
how does
now.
a country save?
Mm. Yeah, of course now the savings begin at individual household level. They begin at household level. And then they can go to farms. Even government also, at the end, government also has savings. Okay? I hope we are together there. Okay?
Yes, please.
Uh, yes. So we begin at household level, those are individuals, okay? Then we go to farms. Because a household who has saved much can open a farm and start production, okay? Invest what they. Then farms that have saved enough can expand their production what? Farms. And the more we produce as we expand, output increases. And that is what we call national income, okay? The growth, economic growth, which is reflected by those figures, national income figures. Anybody else with any queries in relationship to this? Because we have to get away in a short while. Someone was saying, what of the degree of economic stability? Now, economic stability here, we are talking about government policy. When you say economic stability, that is government policy, either on subsidization and taxation. So it is embedded there, that one, that economic stability. Unless if you are talking about security, the level of security, that one is different. But when we talk of economic stability, we are talking about, in this respect, the taxes and the subsidies. Yes, someone was putting up a hand. Geraldine, unmute and speak to us.
Determine the government policy of taxation taxation.
It is about that
Yes.
one.
Yes.
So, in this, you discover that if government levies high taxes on the producers, okay? You discover that it is going to increase the cost of production. And therefore, when the cost of production is high, there is a likelihood that the levels of output will be low, will be low. But when government increases subsidies, reduces the cost of production. And once the cost of production is reduced, then high levels of production are induced. And that one increases or leads to high national income. So I hope you have got that one. Anything more? Anything more? Stanley is saying, what about the rate of capital inflow? Yeah, when we come to the rate of high capital inflow increases the volume of capital available for investment, okay? And this will increase the volume of output produced, hence high national income. Whereas high capital outflow reduces the volume of capital available for investment, and this will lead to low national income. So because like when capital goes out of the country, when foreigners who are working here take back their money, the levels of production drop, and therefore the levels of investment and production drop, and therefore that one leads to low national income. Okay. Felix is asking, requesting to know here, are we talking about government or producers? I don't know exactly what you mean, but when we talk about national income, we have farms producing, households can produce. So we are talking about production units, those ones. Even government, there are governments who are interested in production, whose policies are in line with production, they have no problem. So they are also taken as government is both a consumer and a producer. So we are talking about the entire economy, all stakeholders included. Because I'm sure when the government taxes higher, the national income will increase. No way. When the government taxes higher, it frustrates production. Taxes increase the cost of production. And once the cost of production is increased, it affects the investment levels. And therefore, in the end also undermines the level of output, which leads to low national income. Okay. Taxes, yes, you are talking about national income. That is, tax is just revenue to government. It is not national income. Yeah? When we are computing national income, we don't look at taxes. We look at what people produce, the value of what has been produced. So a tax is a different concept. When time avails and we get to that topic of taxation, we can be able to address that in that element. Someone is saying, pardon, on the point of capital outflow. We said high outflow of capital reduces the volume of capital available for investment, which undermines output, hence low level of national income. Whereas high level of capital inflow increases the volume of capital available for investment, which promotes production or output, hence high level of national income. So I think that is it, members. Our time is fast spent. I thank you for the participation. I'm requesting that you have these points, can take a screenshot of what you have on the slide and try to engage all of them. because when we ask you for the neutral questions, we require you to give us very substantive explanation such that you qualify for some good marks in each of the points. So I want to thank you so much for participating. I know people are going for other lessons or other engagements. Thank you. I want to thank you all who were in the room and who have participated actively. So if time avails again, next Monday, we shall meet again. And I wish you the very best. Wish you good health. Take care of yourselves. And economics requires that you read and revise it on a daily basis for you to really be a good student who is going to master economics. For now, I wish you the very best. I have been Teacher Paul Auka. Till then, we meet. Thank you.